All right, good morning, everyone, and hope you had a great start of the week, and welcome back to our weekly review session. So, for before we jump into the contents, just a quick reminder that your second test will be on this Thursday. It will open at 9 a.m. and you can do it at any time during the day. The time limit is 90 minutes. So, if you have any questions before the test, just feel free to let me know, and I hope all you guys can do well in the test. All right, so this week we have two wrap-up quiz to cover. So quiz 7 and 8. The topics are efficient market theory, behavioral finance, bond valuation, and bond risk. So the plan for today is to first review some of the most important concepts before each quiz, and then I will go over the questions in the quiz one by one. Okay. So first, a review of the efficient market hypothesis. Efficient market hypothesis, also known as EMH, states that asset prices fully reflect all available information. There are three forms of the EMH. The weak form states that prices reflect past market data. And the semi-strong form states that the prices reflect all publicly available information. And lastly, the strong form is that the prices reflect all public and private information. So the implications are that the excess returns are difficult to achieve, and both technical analysis and the fundamental analysis are less useful if the EMH holds. Next, I want to review the concept of behavioral finance. Remember that the EMH states that investors act rationally and make decisions based on logic instead of emotions. Behavioral finance directly challenges the EMH hypothesis. It states that market prices are not always efficient due to the influence of human psychology and cognitive biases. Therefore, investors are not always rational. Some of the most important psychological biases that affecting decision making are overconfidence, which results in excess trading, increased volatility, and loss aversion. So investors will hold on losing stocks for very long time, and mental accounting, which means investors treat investment separately rather than as a whole portfolio. And lastly, anchoring, which refers to relying too heavily on past prices or round numbers. Okay, so let's jump into the first question of quiz 7. Jill Davis told her broker that she does not want to sell her stocks that are below the price she paid for them. She believes that if she just holds on to them a little longer, they will recover, at which time she will sell them. So we are asked that which behavioral characteristic explains this decision. So from the question, we know that Jill fears to realize a loss caused by holding on stocks below the purchasing price. So she holds on to the investment despite there may be better opportunities elsewhere in the market. This is the concept of loss aversion, which is people tend to prefer avoiding losses rather than acquiring equivalent gains. And the loss aversion will lead to an effect called disposition effect. Investors hold on to losing stocks too long and they hope that they will recover. Therefore, the question description aligns with the concept of loss aversion. And loss aversion can lead to suboptimal investment decisions, as holding on to poorly performing assets may prevent reinvesting in better opportunities. All right, so why the other two options are incorrect? Firstly, conservatism bias occurs when investors underreact to new information. For example, if Jill Davis ignored strong evidence that her stocks would not recover, that would indicate conservatism. And secondly, representativeness bias occurs when investors rely too heavily on past experiences or stereotypes. An example would be if Jill Davis assumed that all stocks that previously rebounded will always recover. That would indicate the representativeness bias. Okay, the second question. After sell the stock, the investor avoids following it in the media. She is afraid that it may subsequently increase in value. And we are also asked which behavioral characteristics explain this decision. So for the first option, the fear of regret, investors avoid monitoring sold stocks to prevent emotional distress, which is what stated in the question. The fear of regret occurs when investors do not want to acknowledge a potentially poor decision. And this bias can lead to avoidance behavior, such as refusing to track past investment choices. And therefore, the fear of regret can prevent investors from learning from their past mistakes and making more rational future investment decisions. Therefore, it is not a good behavior to pursue as an investment. Okay, so you can see the correct answer is fear of regret for this question, and we want to analyze why are the two other options are incorrect. So as we said in the previous question, the representativeness bias occurs when people assume patterns based on past events. And here is an example, can read through it. And the mental accounting happens when investors treat different assets or investments as separate accounts. Obviously, these two are not the situation in this question. Okay, so the third one, all of the following actions are consistent with feelings of regret. Which option does not align with regret aversion? Okay, so let's consider the first option, the selling losers quickly. Investors who hold on to losers often do so to avoid the regret of realizing a loss. Therefore, selling losers quickly prevents regret by taking decisive actions. If the stock rebounds after selling, regret may occur, but the act of quick selling itself does not align with regret aversion. So the key takeaway is that investors attempt to avoid regret by delaying loss realizations, not by acting quickly. So the selling losers quickly does not align with the regret aversion. Next, we consider the other two options. So why hiring a full-service broker aligns with regret aversion? This is because investors may delegate decision-making to brokers to avoid responsibility, which helps them distance themselves from regret if an investment underperforms. And another option is holding on to losers too long. Investors delay selling losers to avoid regret from realizing losses, and they hope the stock will recover to avoid emotional distress, so which aligns with regret aversion. Okay, the next question. Match each example to one of the following behavioral characteristics. So we are giving 3 examples and 3 characteristics to match each other. So we first consider the characteristic mental accounting. So it should be matched with the first statement. It should be matched with the second statement that investors exhibit less risk tolerance in their retirement accounts versus their other stock accounts. The reason is that investors treat accounts separately instead of considering overall wealth. And the risk perceptions vary across different accounts, leading to inconsistent investment strategies. The second characteristic is the disposition effect. It should be matched with investors are reluctant to sell stocks with paper losses. The explanation is that investors hold on to losing stocks and hoping they will recover in the future. Selling a loser means realizing a loss, which causes investors emotional discomfort. So investors tend to hold on losing stocks for a very long time. The third one is regret avoidance. It should be matched with the statement that investors are reluctant to bear losses caused by their unconventional decisions. The reason is that investors prefer conventional choices to avoid personal responsibility. The fear of regret makes them avoid acknowledging poor decision making. Okay, so question 5. It is about behavioral biases in decision making. A retired investor made the following statements. Statement A, I have been very pleased with the returns I've earned on the stock over the past 2 years, and I'm certain that it will be a superior performer in the future. And statement B, I'm pleased with the returns from this stock because I have specific uses for the earnings. For that reason, I certainly want my retirement fund to continue owning this stock. So we are asked to identify which behavioral principle is most consistent with each statement. So let's first consider statement A. In the question, the investor believes that past strong performance guarantees future success. This reflects the concept of overconfidence, where investors assume they have superior knowledge. So such biased expectations can lead to excessive risk-taking. Next, we consider statement B. From the statement, we know that the investor treats earnings from this stock separately from the rest of the portfolio. So this statement is aligned with the concept of mental accounting, where individuals separate their wealth into different accounts instead of evaluating the portfolio as a whole. This behavior may lead to suboptimal asset allocation, because the investor only consider a portion of the portfolio, not consider it holistically. All right. Moving on to the next one. It is asking about the concept of weak form of the efficient market hypothesis. So just a quick concept review. So the weak form of EMH states that stock prices incorporate all past trading information, including historical prices and volume. Therefore, the technical analysis and the fundamental analysis will be less useful under the efficient market hypothesis. All right. So question 7. If markets are efficient, what should be the correlation coefficient between stock returns for two non-overlapping time periods? So we are given four options to choose from. So we know that under the efficient market hypothesis, stock prices follow a random walk, meaning that past price movements do not predict future price changes. This implies that stock returns in non-overlapping time periods should be uncorrelated. And a correlation coefficient of 0 suggests that knowing past returns give no advantages in forecasting future returns. Thereby, a correlation coefficient of 0 suggests that non-overlapping time periods should be uncorrelated. The correct answer is 0. So if the correlation coefficient is 1, which will imply that past returns perfectly predict future returns. And if it is -1, it would mean a perfect negative correlation between past and future returns. And also if the positive numbers of correlation coefficient is also wrong, because any significant correlation would indicate predictability, which is inconsistent with the EMH. And lastly, we're asking about the concept of random walk. So just to review, the random walk hypothesis states that stock prices changes are independent and unpredictable. If markets are efficient, past price movements provide no useful information for predicting future prices. Therefore, the future prices are uncorrelated with past prices. The random walk hypothesis supports the weak form of the efficient market hypothesis, which argue that technical analysis and fundamental analysis is inefficient. Yeah, we already discussed this in the previous question. So the correct answer is future prices are uncorrelated with past prices. All right, so let's move on to quiz 8. Firstly, a quick review of some of the concepts in bond valuation. A key thing to remember is that bond price is the present value of future cash flows discounted at the required yield. A bond is trading at premium if its current yield is greater than yield to maturity. A premium bonds are bonds sold at price that is above their par value. And a bond is trading at discount if the current yield is less than the yield to maturity. And discount bonds are the bonds sold at a price below their par value. So there are 4 traditional yield measures to remember. First one is nominal yield, which equals to the coupon rate divided by the par value. The current yield is the annual coupon payment divided by market price. And there are 2 types of promised yield. The first one is yield to maturity, which is the expected rate of return for a bond if held to maturity. And the next one is yield to call, which is the expected rate of return for bond if held to the first call date. Lastly, the realized yield or the horizon yield. It is the actual return earned during the holding period for a bond. Right, next, I want to quickly review the types of bond risks. There are 3 main categories. The company-specific risk, the risk induced by general level of interest rates, and the risk induced by supply and demand in the market. Within the first category, there is credit risk, which is the possibility of default by the issuer. And in the second category, there are 5 types of risk to remember. The reinvestment risk, interest rate risk, the yield curve risk, call risk, and inflation risk. Can read through the definition following each risk. And lastly, in the third category, we should remember the liquidity risk, which is the difficulty in selling when the price where you can actually buy or sell a bond is different from the price indicated in the market. And next, I want to review the bond price sensitivity to yield changes. One observation is that bond prices move inversely to bond yields. The price volatility increases at a diminishing rate as maturity increases. For a given change in yields, longer maturity bonds experience larger price changes, where higher coupon bonds experience small price fluctuations. All right, so let's go into the first question. It is asking that a bond with an annual coupon rate of 4.8% sells for $970. What is the bond's current yield? So from the previous review slides, we can know that the formula for current yield is equal to the annual coupon payments divided by market price of bond. So we firstly calculate the annual coupon payment. We are given the coupon rate of 4.8%, and we assume the face value is $1,000. Therefore, the annual coupon payment is 4.8% times 1,000, which is equal to 48. The market price of the bond is 970, so we can plug in the formula to get the final answer. Okay, this question is relatively easy. So moving on to next one. A bond has a current yield of 9% and a yield to maturity of 10%. Is the bond selling above or below par value? So firstly, it's very important to understand the relationship between yield to maturity and current yield. Yield to maturity represent the total return if the bond is held to maturity and the current yield only considers the annual coupon relative to market price. Recall that if the yield to maturity is greater than current yield, the bond is trading below par. And if the yield to maturity is less than current yield, the bond is trading above their par value. So in this question, given the current yield is 9% and yield to maturity is 10%, the bond is priced below their par because yield to maturity is greater than current yield. Okay. So question 3. A 30-year maturity 7% coupon bond paying coupon semi-annually is callable in 5 years at a call price of $1,100. The bond currently sells at a yield to maturity of 6% or 3% per half year. The question is to calculate the yield to maturity, the yield to call, and the yield to call if the call price is only $1,050. Okay, so let's first calculate the yield to maturity. From the question statement, we can know the par value of the bond is $1,000, and we need to compute the semi-annual coupon payment because the coupon is paid semi-annually. The coupon rate is 7% annually. Therefore, the annual coupon payment is 7% times $1,000, which is equal to $70. Excuse me. So we can calculate the semi-annual coupon payment to be 7% divided by 2 times 1,000 equal to $35. Next, we calculate the number of periods. From the question, the years to maturity is 30 years, and the bond is paying coupons semi-annually. Therefore, the number of periods should be 30 years times 2, because it pays coupon twice in a year, which is equal to 60. And the yield per period is 3% in the question. All right, so recall that the formula for yield to maturity is the discounted sum of the coupon payment in each period plus the par value discounted at the end of the holding period. So we can then plug in the numbers we get from the calculation, a summation from period 1 to 60. The coupon rate is 35, which should be discounted in each period, and plus the par value discounted at the end of the period. So we get a yield to maturity of about $1,100. All right, so for part B, we are asked to calculate the yield to call. In this part, the call price is $1,100. Next, we calculate the number of periods. We know the time to call is 5 years, and the bond is paying coupons semi-annually. Therefore, the number of periods should be 5 times 2, which equals to 10 periods. And the semi-annual coupon payments is $35 from the previous part. The present value we calculated in the previous question. And we then plug in these numbers into the yield-to-call formula, which is quite similar to the previous part. But the time period should be from 1 to 10 this time. So with some calculation, we can get the yield-to-call to be 2.78% semi-annually, or if you want to express it as annual rate, we should be 5.55%. All right, so moving on to part C. If the yield-to-call is at $1,050, so sorry, we are asked to calculate the yield-to-call at a call price of $1,050. So this part is the same as part 2, just replace the call price here to be $1,050, and everything should be the same. So you can do it by yourself, and the final answer should be a semi-annual rate of 2.378% or annual rate of 4.756. So compare part B and C. We can see that a lower call price results in a lower yield-to-call. The yield-to-call in part C is lower than the yield-to-call in part B. Okay. Question 4. Describe the likely effect on the yield to maturity of a bond resulting from an increase in the issuing firm's times interest earned ratio, an increase in the issuing firm's debt to equity ratio, and an increase in the issuing firm's quick ratio. So let's consider each option one by one. For option A, a higher times interest earned ratio means the firm has better interest coverage, which indicates that it has a greater ability to pay its interest expenses. This will reduce the default risk and increase bond prices. A higher bond prices means a lower yield to maturity. So the conclusion should be a decrease in yield to maturity. For option B, a higher debt to equity ratio means the firm is using more debt financing, which will increase the financial risk and decrease bond prices. Therefore, a lower bond price will result in a higher yield to maturity. So the answer should be increased yield to maturity. And lastly, a higher quick ratio means a better short-term liquidity. Lower default risk lead to higher bond prices. Therefore, higher bond prices will result in a lower yield to maturity. So an increase in the quick ratio will decrease yield to maturity. All right. So for question 5, we want to calculate the current yield and yield to maturity based on the information given in the question. So firstly, we calculate the current yield. The formula for current yield, as a reminder, is the annual coupon payment divided by the market price of the bond. From the question, we are given the coupon rate is 7% annually. Therefore, the annual coupon payment should be 7% times 1,000 par value, which is equal to $70 of annual coupon payment. And the market price is $960. Therefore, the current yield should be divide these two numbers, and we get a 7.29% current yield. The yield to maturity formula is the should be calculated as using this formula. So the present value of the bond equals to the discounted sum of all the coupon payments in each period plus the face value of the bond discounted at the end of the period. From the question, we know that the number of periods is equal to 10 because the bond matures in 5 years and it pays coupon semi-annually. The present value we calculated in the first, it is given in the question, the present value, and the par value should be $1,000. The semi-annual coupon payment is $35, which is annual payments of $70 divided by 2. So we can plug in all this number into the formula and use a financial calculator. We can get a semi-annual yield to maturity to be 3.993%. Or you can annualize it as the following. All right, the next question. A bond with a call feature will have which one of these following characteristics? So let's consider each option one by one. So for A, it states that a bond with a call feature is attractive because the immediate receipt of principal plus premium produces a high return. It is incorrect because although a call results in the bondholder receiving the principal and a call premium, reinvestment risk still exists. Therefore, when a bond is called, interest rates are usually low, meaning reinvestment opportunities are unfavorable. For option B, a bond with a call feature is more apt to be called when interest rates are high because the interest savings will be greater. This one is also incorrect because the bonds are typically called when interest rates are low, not when interest rate is high. Lower rates allow the issuer to refinance debt at a lower cost, which will finally increase the interest savings. For option C, a bond with a call feature will usually have a higher yield to maturity than a similar non-callable bond. So because the callable bonds come with call risk, meaning that the issuer may redeem them before maturity. To compensate investors for this risk, callable bonds must offer a higher yield to maturity than similar non-callable bonds. So this will ensure the investors receive adequate compensation for the possibility of early redemption. Therefore, option C is correct. It is the right answer for this question. So question 7 is asking about the bond pricing, discount versus premium. So this one covers the same concepts we discussed previously, and upon checking your answers in the quiz, you guys are doing well in these questions. So I will just skip this one for now, and you can read through the answer on the slides. If you have any further questions, please feel free to let me know. All right. Moving on to question 8. A 9-year bond paying coupons annually has a yield of 10% and a Macaulay duration of about 7 years. If the market yield changes by 50 basis points, what is the percentage change in the bond's price? So firstly, I want to remind you guys about the formula for price sensitivity. On the left-hand side, we have the percentage change in bond price. And on the right-hand side, we have the Macaulay duration of the bond, D, divided by 1 plus the yield to maturity divided by the number of coupon payments per year, which is the little n. And finally, we should time it with the change in market yield. All right, so in the question, we are given the Macaulay duration of 7.194 years, and the yield to maturity is 10%. The yield change is 50 basis points. Notice that which should be equal to 0.005. And the annual coupons, number of coupon payments per year should be 1 because the bond is paying coupon annually. All right, so we then plug in these numbers into the price sensitivity formula, and we will get a final answer of about negative 0.0327, which indicate a 3.27% decline in bond price. Okay, question 9. Excuse me. The historical yield spread between the AAA bonds and Treasury bonds widened dramatically during the financial crisis. If you believe that the spread would soon return to more typical historical levels, what should you have done? So we need to first understand what is a yield spread. The yield spread is the difference in yields between the AAA corporate bonds and Treasury bonds. A wider than usual spread suggests that AAA bonds are undervalued compared to Treasuries. So, given the definition of the yield spread we just discussed, the optimal investment strategy should be if the spread is expected to narrow, the AAA bonds will appreciate more relative to the Treasury bonds. Therefore, investors should shift from Treasury bonds into a AAA bonds to take advantage of the expected price appreciation. The expected outcome of this investment strategy is, as the yield spread normalizes, a AAA bonds price will rise. And as a result, a AAA bonds will outperform Treasury bonds and generating a higher return. Question 10. You predict that interest rates are about to fall. Which bond will give you the highest capital gain? So let me review the relationship between interest rates and bond prices. The bond prices and interest rates have an inverse relationship, which means when interest rates falls, the bond prices will rise, leading to capital gains. So the first steps, you should understand why the long-term bonds benefit more. This is because longer duration bonds are more sensitive to interest rate changes, and a longer maturity results in larger price fluctuations when yields change. And second, why a zero coupon bonds benefit more. Zero coupon bonds do not pay periodic coupons, meaning all return comes from price appreciation. Because all cash flows are received at maturities, the zero coupon bonds have the highest duration. So we know that higher duration means they experience the largest price increase when interest rates falls. Therefore, combine these two parts, we know that zero coupon and long maturity bonds will give us the highest capital gain. All right, so this is question 11. A 6% coupon bond paying interest annually has a modified duration of 10 years, sells for $800, and is priced at a yield to maturity of 8%. If the yield to maturity increases to 9%, what is the predicted change in price based on the bond's duration? The bond prices will increase or decrease by how much in terms of dollars? So firstly, remember the modified duration formula is percentage change in bond price. The left-hand side should be equal to the negative modified duration times the change in yield to maturity. The first step to solve this question is to rearrange the modified duration formula to calculate the price change, which is equal to negative d times delta y times p. So given the information in the question, the modified duration 10 years, bond price $800, and change in yield to maturity 9% times 9% minus 8%, 1%, we can get a price change to be a negative $80. All right, so the last one is about modified duration. A bond with annual coupon payments has a coupon rate of 8%, yield to maturity of 10%, and Macaulay's duration of 9 years. What is the bond's modified duration? The formula for modified duration should be equals to the Macaulay's duration divided by 1 plus the yield to maturity divided by the number of coupon payments per year. So from the question, we know the Macaulay's duration is 9 years and the yield to maturity is 10% or 0.1, and the number of coupon payments per year should be 1 because it is paying annual coupon payments. Therefore, we can get a modified duration to be 9 divided by 1 plus 0.1 over 1. So the answer should be 8.18. All right, so that concludes our review session today. And if you have any further questions, please feel free to let me know. And good luck with your test on Thursday. See you next week.